What to expect from the UK property market and property prices for the rest of 2021, and what's the outlook for 2022? Yes, you heard me right. I'm actually going to stick my neck out in this video and give you my top predictions for what to expect from the UK property market in 2022, so stay tuned. Hi, I'm Ranjan Bhattacharya. I've been investing in property for 30 years. You may have seen me on the hit Sky TV show Property Elevator or attended one of our property networking events in central London. So we're filming this video in September 2021 in central London at the offices of London law firm Howard Kennedy, right here by London Bridge. And what we're doing here today is actually the judging for the National Property Investor Awards. These take place every year, and I've been on the judging panel for over a decade now, but that is all coming up in a vlog video, especially about that later on. So make sure you subscribe and hit the like button and all of that, and hit the bell icon so you're notified when that video is uploaded. So in this video, we're going to look at the property market for the remainder of 2021, and also those key points you need to know of what to expect for 2022. In August of 2021, there's actually been a small drop in house prices, a drop of 0.3%. It's the first drop we have had in quite a long time in the terms of the monthly house price figures, but it's still against a backdrop of an over 10% rise in the last year. Now, a lot of commentators get very jittery, if you like, by looking at data from just 1 month, and they're saying shock, horror, stamp duty holiday has come to an end. We got a 0.3% fall this in August. This is the start of a trend. Now, if you've been in the game a little while, you know that the property market is seasonal. There are always some seasonal issues that come into play, and August, of course, is the time of holidays. Everyone's on holiday. Buyers are off on holiday, sellers are off on holiday, very little stock comes onto the market, and if you are thinking of selling and don't urgently need a sale, you will normally put off your sale, putting the property onto the market until the September season. It's one of the reasons that if you're looking at property auctions, there aren't any or many property auctions which take place in the month of August for that reason alone. So when you compare the market data, if you like, from this August and you compare it to previous Augusts, you don't really see much of a difference. Now, the important thing I want to mention is, when do you actually call a trend? When do you actually look at market data and say, well, this is actually representative of a long-term shift in what is actually happening in the property market? Well, the property market is generally like an oil supertanker. It takes time to turn around and change direction. Now, how long is that time? It takes at least 3 or 4 consecutive months of a trend happening for you to really call it as a change in direction of the property market. So, for example, we've had this 0.3% drop. For it not to be explained away as a seasonal dip, we have to see monthly falls for the next 3 or 4 months before we start calling it as a long-term trend happening in the property market. There are loads of classic examples of short-term blips that have happened in the property market. Now, I remember at the death of Princess Diana, for the couple of months after her death, it looked as though, if you looked at the property market data just for that month, it would look as though the property market had fallen off a cliff. That's because the nation was in mourning. There was no buying and selling activity going on at all. But literally after 7-8 weeks afterwards, the market started to normalize. So no one would take just 1 month's info out of sort of context and extrapolate a trend unless you actually look for 3-4 months consecutive data to draw those sort of conclusions. So September, of course, is back to school, and with everyone packing their kids back off to school, they've got more time to focus on property, whether it's buying or selling, and it's a time when the property market starts to get that benefit from that back to school bounce. And that will continue right up until Christmas. And then, of course, we'll have the usual Christmas slowdown, and later on in the video, I'll tell you what to expect in 2022. So if you're enjoying this video, make sure you slam that like button. It really helps us out on YouTube, and it means that more people get to see this video because of the YouTube algorithm. And also share this video, because coming up, Later on, I'm going to share with you the top things to expect from 2022. So we have seen the back of the great stamp duty SDLT giveaway. That's all ended and come to an end. But as I predicted from the very beginning, it has had little effect on property prices, it coming into being and also it tapering out of existence. And that's because the stamp duty savings alone does not explain the 10% rise in property prices that we've had over the last year. What explains that is the massive currency printing that's gone on all over the world, which has led to inflation. Inflation in prices of assets and anything that is real. We've just seen in the August data, month-on-month inflation has actually gone up 3.2%, which is one of the highest monthly rises we've seen. And of course, this inflationary trend and effect on asset prices is something that I've been predicting in my videos for over a year now. But not all of this growth that we've seen in property prices down to inflation. There's also a distinct change in consumer trends and tastes. Now, in the old days, and when I'm talking about the old days, I'm talking about pre-COVID, of course, people went to the office every single day of the week. And if you're going to do that 5-day-a-week commute, you want to be within an easy commutable distance from your office location. In the post-COVID world, office workers aren't necessarily going to the office 5 days a week. There is a bit more working from home, there's a bit more flexible working. Some people are going to the office just 3 days a week and working the rest at home. Now, when you're not doing 5-day-a-week commute, then the range of travel that you're willing to do in the morning is a little bit more than in pre-COVID times. And what we're seeing now is the new space race, if you like, the race for space, as people decide to move to cheaper locations, which are a little bit further out from where they usually do the daily commute from, where they can get more space, more bang for their buck. And what that means is that cheaper places where people didn't used to live and commute are now attracting a lot of buyer interest. And what this is doing is evening out the price rises that are happening all over the country. So what we're seeing is pretty much outside of central London, if you like, a rising trend in house prices, which is quite even really, quite evenly distributed. That's partly due to inflation and it's partly due to the commuter belt being expanded due to new flexible working practices taking hold. As we've got our freedom back, the economy has bounced back and jobs, unemployment levels, they've pretty much returned to what they were pre-COVID times. And as a direct consequence, we're seeing that rental demand is high. Well, it's not just high, it's gone up. And that means that rental prices have gone up in most areas of the country. But that doesn't necessarily mean there's been a change in rental yields. Yes, rents have gone up, but so have property prices. So rental yields, not too much change. What we are seeing though is the entrance of institutional money and big money into UK buy-to-let. People like John Lewis, people like Lloyds Bank are looking at getting into buy-to-let stock. But what they are not going to be doing is buying single units, single 2-bedroom terraces in Hull, dotted around all over the place and building portfolios that way. What they're going to be looking at are multi-unit freeholds. That means many lettable units under one rooftop. The reason being you get economies of scale, and because you get better cost benefits, if you like, lower costs of servicing that portfolio, you drive up your net rental yields. And the smart, smaller investors are following those sort of trends by investing and building their own multi-unit freeholds for buy-to-let investment. I've got a video here that we put out recently with one of my masterminder students, Mindy, who has just done this very same concept in Horsham. We'll put a link, take a look at that as well. We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training and I'll leave you to enjoy the rest of the video. So what's going to happen in 2022? Yes, I'm going to actually stick my neck out and tell you my top predictions for what's going to happen in the UK property market in 2022. And I'm going to give you a figure. I'm going to give you a figure of what I believe the national average house price rise will be by the end of 2022. Now, if you're liking this video, don't forget to smash that like button. And if you haven't already done so, subscribe and hit the bell icon so you don't miss out on any of our videos. So in 2022, I think we will see another 10% rise in prices on average nationally. I think there are two main trends that will continue to play out. The first of which is the quantitative easing and the effect of all the currency printing. And the second, of course, is this race for space, which still has a lot of head of steam to let off. Now, let's go back to the quantitative easing and the money printing that's gone on. Now, a lot of that has already happened. So we're out of COVID. Well, the money printing has been done. I mean, what further effect can it have, you could say? Well, let me try to explain this with a small visual aid here. So what you have is money, if you like, money in the economy, which is represented by this water. Now, as people do stuff in the economy, things happen, and as activity takes place, money moves from person and business to business and person, and by that movement, it appears that there's more money in the economy than there actually is. You can see the level is higher than that red indicator that you can see there. Now, what's happened in the last year is the government have gone along and added more money to the economy by doing this. But the economy has been in shutdown, so there hasn't been any movement of that money in the economy. That's what we call the velocity of money. Now, as lockdown is easing and the economy is bouncing back and employment levels are up to pre-COVID levels and the like, economic activity is returning back to normal. And that means the extra money that has been pumped into the economy is circulating in the economy. And that's what's causing this inflationary effect. Because you can see that level, that watermark level is much higher as the economy keeps moving around. And that's the effect that we're seeing play out into 2022. And that's why inflation has hit record levels in terms of monthly increase just last month, gone over 3%. So we're going to continue to see those trends play out into 2022, and that's going to see a fueling of asset prices. The elephant in the room in terms of making predictions for 2022 is, of course, the dreaded COVID virus. I mean, COVID-19, will it be upgraded to COVID-22? Who knows? If it comes back, then of course, these predictions will have to be revised, and I'll be making those predictions on this channel, so make sure you subscribe and hit the bell icon and all of that. But quite frankly, I'm cautiously optimistic that we won't see a return to the dreaded lockdowns that we have had in 2021. But if they do come back in any way, of course, I'll be revising my predictions and you'll get them on this channel. Now, of course, this inflationary effect is also going to have a massive effect on construction costs. Now, I mentioned this race for space. Some people are moving out of town and further out, but some people are staying put and extending. So there's a huge extension and home renovation boom, people building garden offices and the like, that is happening right now. We've also had the issues with Brexit and that effect on labour. We've also had this truck driver crisis that's causing imports to be a little bit more complicated. And of course, the inflationary pressures have meant that the cost of labour and the cost of the materials has gone up and is continuing to do so. Now, this is going to have a significant effect if you're doing any projects that involve development. Now, when you do a project, let's say you're building 5 new houses under planning permission. Now, when you actually secure the site, you will be calculating, estimating all your costs according to certain models and spreadsheets. Now, the problem is, if it's going to take you a year to get planning permission and maybe a year plus to build out, you're looking at trying to guess what the inflationary effect is going to be on your prices and your costs and your materials, often 2 years down the line. And that can be quite difficult. Now, the rule of thumb for many developers is to use a 10% contingency. I would recommend you do projects where you're looking at 20% contingency, because you are going to be likely looking at greater development costs on your projects, particularly the ones that are done under planning permission, because the cycle from start to finish is so much longer. If you're doing projects under permitted development, which anyone who watches this channel regularly will know that I'm a big fan of, you'll know that your cycle of a project, your life cycle of a project, is far shorter. It takes 56 days to get your permitted development approved, and because you are not building buildings from scratch under permitted development, you're working at reconfiguring within the building within its existing envelope. The whole build-out cycle is a lot shorter as well. And those projects can be good, because if you're entering into a permitted development commercial to residential conversion project where you're, say, building 6 flats, and you can do that project in a year, then you don't have to estimate too far into the long term what your building costs may be. The other thing to bear in mind when building costs are rising is the fact that much of your expenditure is actually later on in the build cycle. It's what we call second fix. It's when you're putting all the sort of bathrooms and kitchens and floorings and the finishing items into a new build project. Now, typically those sort of second fix items are imported. Very few fancy kitchens and all of that are actually made in the UK. So these things are all imported. And of course, we have seen massive upward pressure on prices in these sort of materials. If you're doing a development project right now, when you're doing your figures, I would personally encourage you guys to look for 30% margins and 40% return on costs as your sort of hurdle rate for making sure that you're going to do a successful project in these in the times to come. If you want to know more about what all that means and how to evaluate those sort of costs, leave a comment in the comments below. Just write more on building costs or something like that, and I'll do a forthcoming video on that very subject. Now, I get asked a lot because everyone knows I'm a bit London centric, and I love London really, but I get asked a lot about what's happening to the London market, what's likely to be the outlook for it in 2022. Now, as travel slowly returns to normal, and it hasn't returned as of September 2021, but it's slowly getting back to normal. Once travel restrictions become normal, people don't have to quarantine in a government slum hotel or something like that for 2 weeks and all that sort of nonsense. Once all that sort of thing normalizes, we will start to see the spring back of the prime central London market. Now, one of the main drivers of that is that the pound is actually undervalued compared to many international currencies, and prime London property is actually not bad value when you actually compare it to similar properties in other world cities. Now, I mentioned that the pound is undervalued. The main reason for that is that we've done a lot of currency printing in the UK, but a lot of other countries have done a lot more than us. So relative to other currencies, we're actually not bad. And our economy, particularly because of the fast vaccination rollout, has actually come out of this quite well, quite frankly. So that's why, relative to some other currencies, the pound is looking good, and that's going to attract international investors as soon as the travel restrictions start to ease a bit. Now, prime London is not really of that much interest to you guys and buy-to-let investors generally out there from the UK. It's driven primarily by the international market and people that really want to just store wealth, because prime London is over time a decent store of value. But a lot of people, a lot of domestic investors from the UK are interested in some of the outer London areas. Now, there is something in London which is going to go the same way as the dodo, in other words, become totally extinct, and that is freehold houses which are under £300,000. Now, there are a few left. There are a few areas within the M25 zone where you can still buy freehold houses for that sort of money. Now, my advice would be, if they're well located, good transport links, good local population dynamics and all of that, grab those. They won't be around for long. The inflationary effects and all the rest of it will soon see freeholds in the M25 area go far beyond £300,000, and possibly it won't be that long before you won't really get anything for under £400,000 or £450,000. Now, we all know and I've done videos on this as well, that if you are a buy-to-let investor, you're looking at rental property for the long term, you are better off owning freehold than leasehold because your net yield is going to be a little bit higher. So if you want to do London, you really want to focus on freeholds, and there are very few of those opportunities left. Now, London's of course massive. There are 8 million people in the city. It's a very wide geographic zone, which is described as London. Where do you want to go for the best value? I would go east. Now, when I started investing in property, I went for Islington, and this was in the 1990s. Islington had a hipster quality about it. It was gritty, if you like. It was really close to get to the centre of town. It had good transport connections and all of that, but it had a little bit of a gritty element. There were creative types moving in and all of that sort of stuff. Now it's of course gentrified, and quite frankly, if you're looking at buy-to-let, you'd be nuts to buy somewhere like Islington. The figures don't stack up. So what areas of London demonstrate those sort of characteristics, that sort of vibe, that sort of gritty, creative vibe, independent coffee shops sort of coming up all over the place, young creative types in residence. What sort of places in London actually have that sort of vibe? You tend to find them in the East Hams, the Shoreditches, all these sort of areas, which just 5-10 years ago were absolute slums and toilets. They're really coming up, and in the next few years, particularly with this inflationary effect that we're going to see with property prices, what you will really capitalize on if you want capital growth is to head for areas where there is a zing there. There's a zing factor there. In other words, what I mean by that is that it's going to grow. It's got something about the area where it's growing at a rate which will outpace the average. The average growth for next year, as I've said earlier, will be about 10%. Now, if you can capture some of these up-and-coming gentrifying areas of the future, you will outpace that 10%. And if in London you want to do that, I'd head east. And of course, the post-COVID trends in commercial property will continue to play out. In other words, there's a massive oversupply of offices and shops, which are increasingly going to become defunct. And thanks to permitted development rights, they can be very easily repurposed to residential use under a light touch planning regime. Now, when you look at what the big institutions are doing, people like John Lewis and Lloyds Bank who are getting into property, they're looking at large build-to-rent schemes and buying multiple let units under one roof. Now, that's what this PD allows you to do. It allows you to take defunct commercial buildings and build multiple flats under one rooftop. And if you keep those for build to rent, you will be producing some very good yields out of that, very good net yields out of that. And that's going to be where the smart buy-to-let investors will be. Now, if you want to know more about capitalizing on that strategy, I run some special free 90-minute masterclasses on the subject. You can join me at the link below at the bottom of the screen. The link's in the description. If you enjoyed this video, don't go away without smashing that like button, and also make sure you subscribe and hit the bell icon for more from me in the future. Bye for now.